Everyone, this is Mike Kramer of Mott Capital with a pre-CPI check-in. Today is April 11th. It is around 9 a.m. Tomorrow, the CPI will be coming out on April 12th at 8:30 a.m. New York time. Estimates are for 0.2% month over month versus last month's reading of 0.4. CPI ex food and energy expected to rise 0.4% down from 0.5%. CPI year over year up 5.1% versus 6% last month. And CPI ex food and energy year over year expected to rise to 5.6% from 5.5%. So clearly this is a number I think that's going to start taking a lot of precedent over this headline number because again you can see that the headline number is coming down. That's largely due to some goods disinflation, to energy prices obviously coming down, gasoline prices coming down, and meanwhile you're still getting a large core number because you have this component which the market calls the super core, and Bloomberg tracks this number. Super core CPI last month was up 0.5%. This is sort of core X housing, up 0.5%, and you can see it's been trending higher now for the last couple of months. So this will be an important reading that the Fed is first of all watching very closely, and the market's going to also be paying attention to. And when we think about why maybe that core number isn't coming down, it's because you still have a super core number that's still running at around 6.1% as of February. So again, you're going to want to see some improvement in this number. Otherwise, you're potentially looking at what we're looking at is a situation where you're going to get like a sticky inflation reading, maybe in this 5 to 6% range for core, and that's going to be a problematic number, especially for those market participants that are expecting the Fed to cut rates this year. Because if you have this sort of super core reading still up here with over a 6 handle, it's going to be really tough to get core CPI, trending even lower, and that's going to be a major hurdle to getting the Fed to sort of back off raising rates. And so this is a pretty important number. The other thing to take a look at here is that, if we look at inflation swaps right now, they're pricing in a 5.02% CPI number. So that's lower than overall estimates, which could be an indication that maybe we're going to get a slightly cooler than expected headline number. That's certainly possible, but that's based again off of market pricing. So it's worth considering that there's a good chance even that we get a slight miss on the headline CPI, but we still get a really sort of strong and sticky core CPI number. So this is going to be a very difficult sort of CPI reading, and I think going forward, these data points are going to become much more difficult to dissect and to break down because it's not going to be just as easy as, oh, inflation is rising and oh, inflation is cooling. I think it's going to become more of a what's going on with the internal metrics of inflation that's going to really begin to matter more. When we look at this CPI ex food and energy and sort of drill down into the survey, what we'll see here is that the median is 5.6%, the average is 5.6%. And what's interesting is that if we take a look at some of the top-ranked, analysts here, as noted by Bloomberg, you can see that all of them are looking for 5.6% or higher. And so that sort of gives you a feeling that, there's probably a good chance that these numbers are going to come in somewhere in line. Because overall, over time, again, if we look at this number and then we compare it to, analyst estimates, what you'll see is that analysts have done a fairly good job of predicting core CPI, a much better job of predicting core CPI than predicting headline CPI. And that's probably because you don't have all the volatility of things like gasoline and oil and commodity prices that are driving, some of these headline CPI numbers. So this is going to be a really key and important part of the metric. And again, the super core reading, sort of core CPI ex housing is also going to be a very, very important metric because again, the market has largely been, discounting and pricing in, rate cuts because the market largely has been pricing in rate cuts now, from the Fed starting, as soon as July or August. And this view has sort of changed a little bit over the last week or so. You can see that before the BLS job report, rate cuts were starting in May and June, and now they've sort of moved out just a little bit. So certainly a CPI reading that shows a core metric, well into the 5.5% to 6% range is going to really make it tough for the Fed to even consider rate cuts. Officials come out and talk about how, they're trying to use this dual approach to dealing with the banking issues and having to deal with through funding and liquidity, and dealing with monetary policy through interest rates and inflation. That's certainly going to also sort of make things very tough for them. Plus, there are signs that maybe the bank crisis is beginning to ease, because we've seen usage of the federal home loan facility being used less, and we've seen the discount window being used less, and those are certainly signs of the liquidity crunch potentially passing. And again, if those signs begin to continue to ebb, and you see discount window activity beginning to slow, and you see, and you begin to see again, inflation remains sticky and high, you're going to see that this market's going to continually reprice towards a higher and higher terminal rates. And so when we look at, again, where we are in the cycle, again, we're still very much in this sort of 40-day cycle. We've talked about 40 to 80 days with the in between points. So again, the job report certainly, came on last week, and we're certainly still in a position to potentially see the S&P move down towards the lower end of the range. Certainly, your invalidation level again remains somewhere around this 41.50 area on the cash market, because that would be the area where you would break that downtrend that started here on August 15th. So again, that's what we're sort of looking at from that standpoint. Now, the Dow has certainly continued to try to consolidate here around this 33,500 to 600 region. You can see again, this has been the big level of support and resistance. Again, if we break through resistance here, there's a really good chance you could see the Dow move up to around 34,200, while a failure to maintain to a failure to break through results in potentially steep decline back towards 31,700. Clearly when we look at things like the momentum of the Dow, you can clearly see it starting to turn a little bit more positive again, which could suggest that there is still a little bit more further upside here. And when we take a look at the NASDAQ, you can see that the uptrend in the NASDAQ has been broken, at least over the short term. And when, again, we continue to see this, battle zone here around this 12,800 to 12,900 region. We've clearly broken the uptrend. This had been a resistance zone. Clearly, it's now serving as support. So obviously, a failure to hold this level would be a negative. It would probably result in much of this, again, gain vanishing, while a continued, holding of this support level increases the odds that you're going to see a retracement back to the upper end of the trading range, which was last witnessed at the end of in August at around 13,600. The other thing to consider going into tomorrow, if we were to look at the implied volatility setup for tomorrow, at least, it just doesn't seem like implied volatility at this point is very high. Now, these numbers can continue to rise throughout the day. We're looking at the live implied volatility metrics in Bloomberg, and they're showing you that basically implied vol for tomorrow is just a little bit over 20, which just isn't really a very high reading, which suggests to me that, there's not a lot of fear out there going into tomorrow's event. There's not a lot of people placing hedges on tomorrow's event, and what that means is that the likelihood of a very big sharp rally following the release of the data is not going to be very likely. In fact, what this kind of implies to me is that the risk here isn't that there will be a big rally following tomorrow's CPI data, but the risk here is that there could be a big sell-off. The reason being because if implied volatility was much higher, let's say 30, 40, 50, and in other words, it would take a significantly hot CPI number to push implied volatility even higher. In the absence of implied volatility going higher, implied volatility will melt. Once implied volatility begins to melt, that results in put selling, market makers buying back, hedges, unwinding positions, which causes the mechanical move higher in the S&P and mechanical move higher in the stock market. However, in this case, because implied volatility is low, there is a possibility that you could get a slight beat, or even an inline to a slightly hot number tomorrow, which could result in the market thinking about more rate hikes coming, or solidify another 25 basis point rate hike for May, which currently is only at a 72% odd. That could result in implied volatility actually rising because it's not very high currently going into that event. And so that's really where the risk here is. So, if we look at the technical setup of the S&P and we just look at the S&P 500 futures, for example, the big level of support in the S&P 500 futures has been around this, 4,100 region, which equates to around 40.80 or so on the cash market. And so if you were to get a break of that 40.80 level tomorrow, and you were to get implied volatility to move higher, you could really see a significant sell-off going into this, given that the fact that there just doesn't seem to be a lot of hedging going on at this point. Now, again, this number is going to likely change, and it could potentially go higher throughout today. But depending on where this number is tomorrow morning is really going to determine whether or not, traders, after the data comes out, determine whether or not traders are going to be putting on more hedges in fear of more rate hikes coming. And that's really the big risk here, because, again, the market right now is not positioned for that type of outcome. It's sort of positioned in this, lower volatility type of setting. And that would mean that, you're not going to likely see a huge rally in stocks tomorrow on an inline or slight miss. You're more likely to see a huge sell-off if there's an inline to hotter number. So that's something to be mindful of, because, again, implied volatility very low going into this. Anyway, that's all I have for you. We'll see you soon. Bye.